Good Wednesday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon Remarket Show with this man, Dimitri Pragmatic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I at Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Awesome.
And I'm going to share my screen. While I'm doing that, if anybody is joining us for the first time, Will and I, we do these shows in the morning to help answer questions you have about Market Chameleon tools, data, analytics. If you want to ask a question, you could type it into the live chat on YouTube. If you would like to come in and ask your question live and direct, we also provide a link to Zoom on that YouTube live chat. Click over to Zoom. Once you're in Zoom, click raise your hand. Then you could ask your question live. While we're waiting for questions to come in and more people to join us, we're going to give it a couple minutes. We'll start taking a look at the pre-market report, see if we could get some insights on what's trading in the pre-market hours, and then we'll move on to the questions. So let's start out with the pre-market report. These are stocks that are trading in the pre-market hours. We're going to come down here and we see we have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. There are 43 stocks that made our percentage gainers list, 40 on the decliners. From this perspective, it looks like pretty balanced at the open. Here we're looking if there's any type of bullish or bearish sentiment in the trading in the pre-market hours. And these are stocks that have to meet certain thresholds to make our list, either with volume, liquidity, price move. So this so far looks pretty balanced. Let's come up here and we have this calendar view, which is a summary of what happened in the pre-market hours. So you could go back in history. Right now we're August 23rd. This is today. And this is a summary of what's been going on in the pre-market hours up to now. We're still half hour away from the open. But up to now, we see there are 370 stocks that have traded in the pre-market hours that are trading higher than the previous day's close, and 281 stocks trading lower. As far as volume, there is 68.7 million shares traded in the pre-market hours on up volume versus 115 million shares traded on down volume. And if we convert that volume to dollar value, so we do see more shares traded on down volume than up volume. But if we convert the volume versus the dollar price paid, because not every stock is the same price, we see $2.2 billion worth of stock traded higher versus $1.3 billion worth of stock traded lower. So, from this, it seems probably slightly lean towards bullish sentiment in the pre-market hours, but, kind of mixed bag there too. But it does look from that perspective, we're slightly bullish. Let's come down here and we'll do one more check before we move on to the questions. We see there are in this list of stocks, we have stocks that are low cap stocks. We have stocks that are ETFs, leverage products, could be a preferred stock, could be closed-end fund. Any stock that's listed on a major U.S. exchange that's trading in the pre-market hours and meets our thresholds could make this initial list. And to narrow down these stocks, we could use the filters above. If you do have a watch list, you could filter all these by your watch list. I'm going to use this one, an ETF filter. When you click on it, get a drop down menu to select from, and I'm going to pick this top ETF SPY. When you click on it, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the S&P 500 constituents. Here we see 4 stocks made our percentage gainers list, 8 made our percentage decliners list. So this is going kind of the other way. In the S&P 500, if we look at that market breadth, it looks like it's set up for a slightly bearish bias at the open. So, mixed signals today. I would say probably just neutral trading in the pre-markets. Nothing overwhelmingly indicates bullish sentiment. Nothing overwhelmingly indicates that there's bearish sentiment. Kind of just a mixed bag. Looking through all the stuff. So we are a couple minutes in to we'll take some questions now, I guess, if we have.
Yeah, we did have a couple questions pop in, Chuck.
Okay.
Jackie was asking.
Yep. So while looking for that question, I'm gonna unfilter this, come back to it. If you could also use these other filters that we don't usually go over, but if you just want to see which stocks are trading pre-markets on 52-week highs, you could click on that, and then it'll filter the list below by stocks that are hitting new 52-week highs in the morning. So these are biggest percentage gainers. Here's some on the most active list. 52-week lows could go the other way, and see if there's anything on a 52-week low. So a couple big movers here after earnings, and a couple over here. So if those are, important, to some people, those new benchmarks that they hit, if it's important, you could use these filters above. So I'll unfilter it, and I don't know, what did you find the question?
I found it. It was buried. There've been a lot of chat today, so it's buried back there. Jackie Chen's asking the question: which is the best way to trade options? Number 1, find a rising stock first, and then look if there's a cheap option. I'm assuming he's assuming that you can buy, or find a cheap option first and then look for a stock to see if the stock is rising. So, I mean, that's his question. I just figured you'd maybe be able to comment on it.
Right. I mean, I don't know if there's a definitive answer to that question, and a lot of stuff depends, and I don't know if you could say which is the best. Just what are all the variables involved? What is your strategy? How does it fit into your risk management? What is your outlook? Too many factors go into the decision-making process. If there's the best strategy to do continuously, like on a daily basis, if there's always the best strategy to do, then everybody would be doing that strategy, right? Because there's no point not doing the best strategy, right? So if this is the best strategy, everything else is worse than this strategy, then everybody would be sticking just to that one strategy. There's no point doing the second best or third best or fourth best. So it doesn't trade that way. Like, trading is more, it's a skill that you're learning over time, how to make decisions based on many different factors that are being played out, and the markets themselves are dynamic. So what will happen today in the markets is unpredictable, right? We don't know what's going to happen until it starts happening, and a lot of trading is reacting. to new information as it comes in. So we can't even anticipate it. If you're playing a football game, a lot of what you plan out in front, you have plans, but a lot of your actions are based on also real-time information as it's happening. Let's say if you're I don't know, if you're a lawyer, you make a lot of preparation before you get into court, right? Like, so you have to be prepared, and you're probably prepared based on different scenarios that could play out, but you don't know what's going to play out until you get there. Same thing in surgery or whatever. So it is a skill that you would need. Trading is a skill, right? It's experience, it's knowledge, it's how you prepare ahead of time. And there's no way to say this is the best thing, you should just continue doing this forever, or just do it.
And there are many different strategies, right?
Yeah.
That could be one strategy, but there are a lot of people in the option space that I've run into that will never buy it, literally never buy an option. They only look to do things for credit, right? Whether it's a spread or selling an individual option.
They may have a certain style of trading that they want to stick to, but they know that strategy really well, and they can react to the market information as it comes in. And then there's always going to be surprises that you're going to have to adjust your strategies going forward. So there are always errors, new things happening. The markets are evolving, they're changing, and the players are changing as time goes. The technology changes, the rules are changing. So it's something that you really cannot dismiss experience and skills. So the tools are there to help you, but you still need to do that. And I'm saying it because there's this misconception. Well, some people say, well, what is the best strategy? You do hear that a lot. Like, well, just tell me the best trade idea. Tell me the best strategy. Tell me this. But there's no such thing as, the best strategy or best trade idea, because you're continuously reevaluating what's going on in the markets, and how does that fit into other factors that come into play that could be different for you than for somebody else, right? So your unique trading system can require certain things that somebody else's trading system, might need the opposite. And then you might have to transfer some risk between yourselves. But as far as like just relying on something that's the best, I can't answer that. Even with those two questions, with those two scenarios that you gave me, there's no way to answer that, that question, that number one is going to be the best one all the time.
All right, we had another question from Lawrence. He said SPY has an IV rank of 28%. Why are other trading stocks at a lower IV rank? I'm assuming, Lawrence, you're asking the makeup of the SPY stocks within the SPY. Why are they trading at a lower IV rank? Is that the question, Lawrence? He says SEP in October expirations. Actually, sure. Maybe we want to clarify that question. That actually, as I'm reading it now, it doesn't.
All right. So the SPY, the 28th percentile implied volatility. While we're waiting for the clarification, I'll just go over what that means, the IV percentile rank. And when we go over implied volatility on this show, where it's important to understand that the implied volatility, okay, a stock itself does not have an implied volatility. So SPY does not have an implied volatility. Neither does Apple. Neither does NVIDIA. A stock does not have implied volatility. Implied volatility is this derived value from an option price. Okay, it comes from an option price. It doesn't come from the stock itself, right? So a stock is the underlying of the option, but it's the option price that is indicating some implied volatility. Okay, and you work your way backwards by inputting that into an option pricing model, and you get an implied volatility. So if we look at the options chain, right, like here's the options chain in SPY, and we see that there are a lot of different expirations in SPY. And if you click on an expiration, well, you got a lot of different option prices. I got calls on one side, puts on the other. I have different strikes, and I have bids, and I have offers. And the option pricing model, you could only enter in one price here. One option at a time. You get this one price, and then it spits out an implied volatility. But not all option prices, not all option contracts have the same exact implied volatility, right? Because if they all had the same exact implied volatility, it would be easier. But they don't all have the same implied volatility. So how do you choose the implied volatility? How do you track it? Because if you're trying to track an implied, look, we could observe the implied volatility at this moment, for any of these options by using the option pricing model. But how do you track the implied volatility if it's moving up or down, right? Just like if we want to track a stock price, okay, we could compare the current stock price to yesterday's close, right? So this one way to track it, we could compare the current price to start of year, or we could compare it to 52 weeks ago. But there's ways that we could track a stock by referencing it to some historical date and what was the price on that date, right? So right now, the pre-market, this change is based on yesterday's close, right? This is yesterday's close. And how do we know if this price is up or down? Well, we could compare it to yesterday's close, and we see that it's up. But an option doesn't work that way. So you can't track a single option. And well, why not? Right? Why can't we just take this option and just track this forever? Well, number one, this option will expire eventually and disappear. Right? So you see, August 28th is expiration, which means that after August 28th, this option will either expire worthless, or it's going to be in the money and convert to stock, but it's going to disappear. So after that, that's it. There are new options. Number two, the option itself is the profile of it is changing. Okay, so if the stock moves, right, let's say the stock today moves up a lot, well, this option has a delta, and all of a sudden this option that's at the money will become deep in the money. And also, at the end of the day, instead of 4 days to expire, 4 days left to expiration, will have 3 days left, and the next day 2 days left. So all these factor into that this option is not the same option as it was, the previous day, and it's not the same option if the stock moves a lot, right? Well, because all of a sudden it's not an at the money option, it's like deep in the money or deep out of the money, and then the market you could see a skew. So we can't just track a particular option, like we do a stock. So to track the implied volatility, we need to create some constant that we could track, right? We need a constant. What do we need? We need a constant maturity, right? So we need an option, like say that expires exactly 30 days every day, right? So, because then we're comparing apples to apples. If we're looking at an option today with 30 days to expiration, and we want to see how much it changed, we need another option that has 30 days to expiration, and then the next day. So that doesn't exist for, where every day there's a new 30-day option listed, right? It doesn't exist. So we need to come up with a methodology to create a synthetic 30-day, which is basically a weighted average between, options that are straddle 30 days. What else? Yeah.
Lauren did clarify. He said,
Okay.
no, the question was why bother trading individual stocks rather than the SPY? Individual stocks which are lower than the SPY IV.
I'm not sure I know how to answer that question. Why it's a some people want to trade individual stocks because that's what they're interested in. They know those stocks. They know that they're interested in those particular stocks, and that's why they trade them. I'm not.
Some people, some bigger people actually trade the IVs of the individual against the IVs of the.
Yeah, there's strategy,
too.
all types of strategies, right? That that people, there are people who just trade indexes like ETFs or just indexes, and they're very good at that, and they have strategies around those indexes. There are other people who like to trade, for example, earnings. So ETFs and indexes, they don't have an earnings. The stocks that are holdings have earnings, but the ETF itself doesn't have like an earnings date. People like to trade their earnings, or people like to trade other types of scenarios that they use the individual stocks. So I don't, that's really the only way I could answer that question.
All right, there you go. We did I think I maybe in the question. Jackie was asking, how do you screen? I think it was for bullish put spreads for ETFs. Is there a way to screen for bullish put spread?
Yeah. So if you come up here under screeners, over here we have bull put spreads, right? So I'm going to bring this up, and what this will do will bring up different combinations of bullish put spreads. So you could see here, right now it's defaulted to sort by market cap. So a lot of bull put spreads for Apple. And it is under here, it is defaulted to the next monthly expiration. So if you want to pick a particular expiration, you could do that here. If you want to do like maybe, expirations that are all expirations that expire next 30 days, you could pick that here, the filters, and this will filter out, different expirations. Here are the different expirations that expire within the next 13 days. This is the bull put spread, selling this strike, buying this strike. So when you're doing a bullish put spread, you're selling a higher strike, buying a lower strike, right? And if you wanted to do it by ETFs, let me see. I think you go under underlying stock ideas over here. You see this stock type. Open that filter and choose ETF. So once you do that, what it will do is only return ETFs. So you could see now SPY is making the list because it has a high market cap. And then you just keep narrowing down based on criteria, other criteria you look for in a bullish put spread, right? Like, could use, I'm going to leave this where the strikes, the two strikes, the difference between the two strikes is max $5. But if you wanted to just kind of, you could use one of our preset filters, or if you wanted to say, just show me for each one best by theoretical edge, or best by theoretical win rate, best return if stock is flat. But here, I'll pick this one. So screen out the best bullish put spread based on what best by what, right? It has to be best by something. So best by this one, the return if the stock just sits here or goes higher, right? So if over here, here's a bullish put spread in SPY. It's August 25th, selling the 438 put, buying the 437 put. It's a 41-cent credit right now. So that's a little bit below our Theo, 41-cent credit. But we screened it by best return if the stock is flat. So if the stock just sits here, well, what will happen? Well, the stock is 438.10. So if you sold the 438 put, bought the 437 put, both these puts expire worthless, right, at expiration, meaning you're going to keep that credit, 41 cents. Well, what is your risk? Well, your risk is 59 cents, right? Because your risk is that if the stock collapses below 437, the put spread's worth $1. That's where you'd have to close out of it. So if you sold it for 41 cents, close out of it for $1, you lost 59 cents. So if your risk is 59 cents and on August 25th, if the stock is 438.10 and both these puts expire worthless, that means you profited 41 cents versus 59 cents at risk, right? You risked 59 cents and you made 41 cents. So your return on your risk was 69.5%. Okay, so that's just one screen just to show you how to narrow down, because otherwise you'd have to, you could use all these other filters, but you're going to get a bunch of them for SPY, for example. So it's one way just to quickly narrow down by certain criteria, right? That's a quick way to screen for bullish put spreads with only ETFs. Okay.
Yeah, that was awesome, D.
Okay.
Well, right up against the opening, we did have one question from a new chameleon asking about key levels for SPY, where you can see that on the site. I don't know if that's the moving averages. If he wants to email support at MarketChameleon, definitely do that. Awesome job, D, as always. Thanks so much.
Yep. Thanks everyone for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, chameleons. Have a great day. Thanks, D.